Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, so let's start. So today we'll talk about market efficiency and predictability. So last week we talked about predictability is a cross-section, and we said, this predictor in the cross-section will cause the predictability in the time series as well. So today we want to see how market efficiency and time series predictability is formed in the equity market. So before we begin, I have some questions for you, right? Sometimes you see a lot of these statements. The question is, would these statements be potentially wrong? What's wrong with this statement? Right, so for example, the first statement, the market declines temporarily because of profit taking. It should bounce back next week. You see this kind of statement a lot in the newspapers. Right, they will describe, the market is down, and then say, this is after a period of market increase, and this is a profit taking by the investors. Then it should bounce back next week. Anything wrong with this?
So if the market is efficient, we shouldn't predict how, we can't predict it would bounce back next week?
Yeah, or in other words, if you know the market will bounce back next week, why don't you just invest this week? Yeah. Why do you want to do the profit taking, selling the stock this week? or even if someone wants to sell the stock, there are others in the market that are willing to actually invest this week, which will prevent this market decline temporarily. Right, so this is clearly a violation of market efficiency. The second statement is sort of more deceiving. You hear this a lot also. People ask you to buy stocks with strong companies, meaning they should have good earnings and a good earnings growth. These companies will be profitable and they will give better returns to the stockholders. Sounds perfectly reasonable, right? What's wrong with this approach?
The price has already reflected the potential.
Good. So although these companies are good companies, have high earning growth and high earnings, but it doesn't mean the price is cheap. All right, so the price of the company should actually reflect the fundamentals of those companies, which means in terms of returns, it's actually may not be a good investment and give you sort of higher return in the long run at all. All right, so this is also a violation of market efficiency. That's sort of assuming at least some investors on the market, they are not aware of, these companies are companies of high earning and high earning growth. Then you also see statements like this: the stock market rises slowly as information diffuses through the market. This one's a little bit more tricky, right? And under the sort of strict definition of the market efficiency, this should certainly not be true, right? But people has been increasing find evidence that sort of support this statement. Right. So although in the market efficiency we know, if it's sort of at least weak efficiency, the stock price should reflect all the public information immediately, right? But sometimes because the public information also needs the medium to travel to reach the investors, right? So some marginal investor actually are not aware of the news at the time, and this causes the price rises slowly with some good news. And that is sort of against the market efficiency statement. But it's nevertheless, people actually find this to be, find evidence to support this increasingly. All right. But overall, all these statements are against the market efficiency. All right. So how do we actually say market is efficient or not efficient? If market is efficient, one of the things people assume is that market has what's called rational expectations, which means the realized return, RIT plus 1, should be equal to the conditional expected return, the RIT plus 1 conditional on the information at time t, plus some random noise. Right, so it's called the rational expectation because on average, if you take the expectation on both sides of this equation, you have expected RIT plus 1 equals to expected RIT plus 1. So on average, they should be on target in expectations, given the information, right? But then you can actually make mistakes randomly. But what is this expected RIT plus 1? Then we need to introduce a model, right? So we were seeing all kinds of models, but if we summarize the model we have seen, we will say the expected RIT plus 1 condition on information t should be equal to some function f of xt plus 1. Right, so this f xt plus 1 can be like Kaplan model, multi-factor model, all these kind of models. But the point is, all the model we've seen is about the returns in the same period. Right, so this is subscript by t plus 1. On the right-hand side, you also subscript by t plus 1 as well. Right, so if you think about the Kaplan model, think about the multi-factor model, all these models speaking of the returns and the factors in the same period. There's nothing about prediction in our model, okay? So what does the market efficiency mean? Market efficiency means the stock price or stock returns should fully and correctly review all the available information that determines the security price. Which, in terms of the model we write here, that means the expected, the abnormal return, which is the difference between the realized return and the conditional expectation of the return. The expectation of this abnormal return should equal to 0. Right, that's very easy to see. That's because if we sort of move this to the left-hand side, then if you take the expectation on both sides, this should be equal to 0. Which means if market is efficient, nobody should actually earn any abnormal returns on average. Right, so you can get lucky this period, get unlucky next period, but you cannot consistently beat the market based on available public information. Okay, if you have some information by your own, that's fine, you can earn the abnormal return. But if you're just conditioning on the information that's available on the market, then you should not earn any abnormal returns. So that's sort of a formal definition of market efficiency. So what does this market efficiency tells us? This tells us to test the market efficiency is actually really difficult because we have this giant hypothesis issue, right? So in order to actually, for us to know what the abnormal return is, we have to define or have to know what the normal return is first. But to get the normal return, how do we define the normal return? So normal return is coming from some asset pricing model, right? So in order for us to actually know market efficient or not, we have to know what the correct model is. Right? As we have seen there beforehand, we have all kinds of models, but we don't really know what model is actually the correct model. Right? Even we sort of take a multi-factor approach, we know there's multiple factors that determine the stock return, but we don't really know how many factors in that. We don't really know what these factors precisely are, except for the first factor should be the market return. Right? So this is a huge issue because we always run into this giant hypothesis problem when we test the market efficiency. And that's partly why there's a lot of debate on the market about whether the market is efficient or not efficient. All right, so on Water, you have this file called The Great Divide. This is written by someone from a hedge fund called AQR. AQR is probably one of the best run quantitative-based hedge fund in the world. The author, he is a partner at AQR. He's a student of Eugene Farmer. Right, so this is article he's written after Eugene Farmer and Robert Shiller got the Nobel Prize at the same time. Right, so Eugene Farmer is sort of a representative of market efficiency camp. He thinks the market, by and large, is efficient. And Robert Shiller is a representative of market inefficient camp. He's sort of one of the forerunners of behavioral finance. So Nobel Committee gives them the Nobel Prize at the same time, right? Which means Nobel Committee doesn't really know market is efficient or not efficient, all right? So if you read through this article, it's a very interesting reading. He gives you all the evidence, why he thinks market is or is not efficient, and with the experience of running their own fund, right? So fundamentally, why we have such a sort of difficult time to actually, say market is efficient or not efficient is because of this joint hypothesis issue, right? But you should be aware that when we talk about market efficiency, nobody's really talking about sort of perfect efficiency, right? Although in your textbook, you have this market efficiency in the strong form, weak form, all these things. But perfect efficiency is kind of hard to imagine and unrealistic because we have frictions in the market, like trading cost, right? So one of sort of condition for the market efficiency in your textbook is those frictions such as trading cost is negligible. It's really small. It will not affect the efficiency. All right. So the question is, any of the deviation from this efficient market hypothesis will be exceeding the reasonable transaction cost. So we can see some sort of empirical evidence in testing that. One of frequent test is to sort of test the time series correlation between the stock returns. All right, so for example, if we have a simple model that sort of assume expected return is constant, then we can write the t-period return RT equals to A plus B times RT minus 1 plus some error term. And market efficiency means this coefficient B equal to 0. All right. You cannot predict the next period return with just the return of the last period. But this error term can actually move. That's based on the news or based on the cash flow news, for example, the dividend, right? So systematically, it's not depending on the lag of the return, but you can have error term based on the news. That's basically what the model says. Okay, so let's get some data. So this is data of daily returns of S&P 500. So that's index, right? So this is already got the sort of idiosyncratic component of the stocks out. Right, so I can calculate the returns based on the adjusted close price. With this, I can calculate the lag returns. In Python, that's just shift 1 of the return itself. Then I can run the return IT on the lag return t minus 1. And here's my result, right? So at the first glance, you say, oh, this lag return has positive t. And that's sort of significant in 2.227. But this coefficient is small, right? So does that really mean market not efficient? We can predict the returns in the time series with the daily returns? So if you are using this approach sort of to actually do your investment, how likely will you be succeeding with this with this investment strategy? What's the statistic you're looking for? How likely you'll be succeeding with this strategy? t-value is just tells you how much. The parameter is just telling you, how much of this 1% change in the lag return will affect the future return, and t-value is, whether this parameter is significant or not. Someone already said it. You're looking for the R-square, right? So R-square is telling you how much the variation of RT can be explained by the variation in RT minus 1. Right? So although this is statistically significant, but if you look at the R-square, that's virtually 0. Right? Which means if you're sort of trying to implement this strategy, this is not going to overcome any of the transaction cost, because the chance of you are sort of getting correct is extremely low. Right? So there's not a lot of evidence that sort of go against the market efficiency in the daily data. What about annual data? Right? So what I do here is to just resample as a frequency annual, and then recalculate the returns. Then I get the annual return in SP 500. Right? Now I can again calculate the lag and do the regression in the lag return. Here we see that the coefficient is actually small and negative, and the t-value is really, really small. Right? So again, in the annual data, we can't see any evidence of going against market efficiency with the stock indexes. Right? And if you look at sort of R-square, this is really small. Adjusted R-square is even negative. So this is sort of makes sense, right? If you can actually predict the future return with the lag return in the annual frequency, then everybody will be rushing to do that. After all, it's not actually difficult to run a regression like this. All right? So instead of going through all this, let me summarize what people have been found in testing all those efficiency regressions. I think starting from 1980s, numerous papers, numerous persons has been looking at all aspects of those prediction problems. But to summarize, in the individual stocks, you have negative daily autocorrelations. But in the broad index, usually you'll find a positive daily correlations. All right, but these effects are really, really small, and even smaller in the recent data. Any of the predictability, if you find any, is really weak, and largely dependent on whether you include the period of Great Depression or not. And in any case, they won't actually survive reasonable transaction cost. In the annual data, we can't find any of the predictability, and efficient market hypothesis holds up pretty well in the US data at least. Right? This is not to say if you use some sort of frontier market or emerging market data, you can't find some of the predictability. But by and large, most of these predictability people find cannot survive the transaction cost. Right? And by the way, if you know sort of the time series econometrics issues, right, you will know this T statistics you calculate from the time series regression is actually not very accurate. Right? That's sort of one of the reasons we don't really trust this T statistic in the daily data. And the people actually devised other ways of testing market efficiency other than looking at the time series regressions. And that we'll talk about probably next week. Okay, so in terms of time series regressions, there's not a lot of evidence, right? But that is not to say, as we said, the market is efficient all the time. Or any of the efficiency we talk about is relative, right? One of the reasons is what's called the information paradox. That's due to Grossman and Stiglitz. What does the information paradox says is that if market is efficient, as we have seen before, all you need to do is to invest in market portfolio, right? Because market portfolio is efficient. Market portfolio satisfies the mean variance criteria, and any combination of the market portfolio, because they are mean variance efficient, and the combination is still mean variance efficient. So you don't really need to do much. You just need to invest in market portfolio and be done with it, right? But if everyone is doing this investing market portfolio, which means investing passively, nobody is going to acquire any of the information, especially when those information cost money, right? So who's going to pay the analyst? Who's going to pay your stock advisor? Who's going to pay all those research that's being done on the market? Because the market is efficient, after all, right? Why would you actually pay to acquire information about the market? But if everyone is not paying for the cost of acquiring information, how can everyone based on their investment based according to the most current information? Right, so this is a paradox. If everyone assumes market is efficient, no one's going to generate information. If no one's going to generate information, then why would the market be actually efficient? Right, so this is what's called the Grossman-Stiglitz information paradox. And because of this, people are actually aware all the information is relative. Absolute efficiency is not possible. Right, but nevertheless, the efficiency hypothesis is really important, right? So this will actually help us to think about whether you sort of should or should not invest in some market. If you see some mispricing, do you think this is temporary mispricing, or do you think this is the factor that you can sort of take advantage of? Right? So if you read this article I posted online, they got into some of this, right? Why do they think HML, which is one of the strategies they implement when they form the fund, why is this likely to be sort of a factor instead of mispricing? Okay, so let me actually give you one example. So anyone know this guy? His name is Jim Cramer, right? He ran a show on CNBC, which is sort of the business channel in the US, called Mad Money, right? So if you watch the show, he's sort of constantly, just like that, screening on the TV screen, and they will say, you should buy this stock, or that stock is crap, all these things, right now, with sort of very dramatic manners, right? So the question is, whether his show actually have any implication on the stock returns? Right? If you think the market is efficient, whatever he's telling you is public information already, right? Maybe you don't know, but I'm sure most of the people in the fund management community actually knows about these informations. All right, so if you think the market is really efficient, maybe his show doesn't matter. But if you think the market is not efficient all the time, maybe his show matters, right? So the question is, do we actually see any effect of his show? So this is the abnormal return around the airing of his show. Right, so if you have this point, that's the closing of the market before his show is aired. And the next point here, the next trading day, is the opening of the market after his show is aired. What do we see here? Why do you say market is inefficient?
Because there's a huge jump.
Yeah, so by the way, this is the mean cumulative abnormal return of the stocks that's mentioned or recommended on his show. Right? So the stock return jumps up when the show, after the show is aired. Right? So in the next opening, the stock return is high, or the stock price is high, return is positive. Right? But after a while, this abnormal return goes down and sort of goes to around zero. Which means that it has a temporary effect of boosting the stock price, right? But this temporary effect is not sort of fundamentally changing the stock dynamics. It's not changing the stock return in the long run. Right? So is the market efficient? If you look at this, we'll say probably not. Right? But if you look at the long run, you know, after sort of a week or so, in 2 weeks, this abnormal return is zero. So is the market efficient? If you look at, you know, like 2-week horizon, this show has no effect. Right? But we can also look at something else that's sort of more interesting. This is to show you the outstanding short interest. Short interest is how much people have the position of shorting the stocks, right? With the stock that's mentioned on Jane Cramer's show. You'll see that the short interest really shoots up after the show is aired. Which means, why short interest shoots up after the program is aired? Market overreact. Why would you have the short interest? So if you are a fund manager, right, and you see this graph, the first graph, what would you do? Well, one reaction is, I want to buy the stock, but you have to buy the stock before Jane Cramer actually mentioned it, right? You either bribe him to get the information which is illegal, or you sort of buy the stock before anybody does when this market open, which is kind of hard, right? Because there's perfect competition on the market. So what can you do? Because you know this price increase is temporary, right? And there's a lot of fools on the market rushing to actually buy the stock after Jim Cramer mentioned the stock. What you do is just to short the stock when the price increase, knowing that the price will eventually actually decrease in 2 weeks, right? So the fund managers on the market actually know this is a temporary inefficiency. They actually have a lot of short interest that stack around the airing of the program. All right, so this actually also shows you how do you actually make the market efficient. To make the market efficient, you know, not only there are people sort of, you know, there are people actually acting on the popular news but sort of not aware of it. But more importantly, to make it efficient, people should be able to act or short on the information or short on the sort of mispricing on the market. Right? That's how you sort of dynamically make the market efficient. Right, so which sort of gives you this indication if you have some sort of short constraint, then there's more chance of market moving not efficiently. Okay. What I want to also mention is how your strategy R-square can be sort of evaluated in terms of this market efficiency. For example, you have a lot of sort of fund managers or some of the investment companies say, you know, we have really good investment strategy. We have, you know, huge abnormal returns, and they promise you, you know, like 8% abnormal return a year or even a month, right? How do you know, these guys actually are sort of just charlatans, not true, right? One of the way is to look at the R-square of the strategy. Right, so as we see at the beginning, all these predictive regressions have really, really low R-squares, right? But if a fund that's claiming they have a really high R-square, that's too good to be true, okay? That's something you should be aware of. Maybe these guys are sort of cheating, not telling you the truth, right? Why is that? Let's have this regression of time series regression of RIT plus 1 that's regressed on the conditional expected return with some noise, as we see before, right? And to sort of have cleaner representation, I just call this conditional expected return of mu of IT. Right, so what is the R-square of this model? The R-square is just the variance of this part, the conditional expectation part, divided by the variance of the total variance, the RIT plus 1. Right, that's straight from this definition of R-square. Everyone agree, right? So what is the variance of this mu IT? The variance of x equals to expectation of x squared minus expectation x squared. Remember this one? Right? So this on the top, this is less equal to just the expectation of x squared, which is expectation of the mu squared. All right, let's keep the bottom the same. All right, so you see on the top, that's some expected return square. On the bottom, you have variance, which is standard deviation square. Now you recall the expected return over standard deviation, well, that's just Sharpe ratio, right? But Sharpe ratio should be bounded, okay? We have this volatility bound. What's the bound of the Sharpe ratio? Sharpe ratio, the highest Sharpe ratio should be the sigma m over expected m. M is the SDF, right? So that's from the volatility ratio we have in the SDF before. So if we plug this into this equation on above, right? So because in the numerator is just expected return square, in the denominator is just the sigma square. Then we know R square should be less equal to sigma m over expected m square. right? 1 over expected M, we already know that's related to the risk-free rate, right? All we need to know is what is the standard deviation of the SDF. Okay? So the standard deviation of the SDF is about 0.3264. Then if we plug this number into this equation, right, the equation before we have here, assuming the risk-free rate is about 1%, right? Then the number we get is about 10%, 0.01087, right? Which means any strategy that can generate a R-square of about 10% or more than that is a violation of market efficiency. If you find a strategy on the market that can generate some abnormal return and you have R-square that's as high as 10%, that means market is not efficient. Or, on the other hand, if you think the market is efficient, this strategy is too good to be true. Right? If the market is efficient, it's just not possible to find a strategy that have a very high R-square and still generate you the positive abnormal returns. Right? So sometimes, students see, we have this asset pricing regressions. In the typical asset pricing regressions, R-square is about 5% or 6%, and they will say, oh, your R-square is so low. Well, that's normal, right? But if you really have a regression that have really, really high R-square, that usually means you made some mistake in your program. That usually means it's not possible, okay? So, sometimes when I see the paper written by students or regression run by students, I just look at the R-square, I see really big R-square, immediately you're wrong, okay? So low R-square is actually a feature of the market. Okay, so what we have talked about so far is predictability in what we call the short run, right? So we have daily, weekly, monthly, and up to annually. What we want to talk about next is the predictability in the long run, usually more than 1 year in terms of dimensions, right? And what we will see is, in the long run, predictability may exist, but it does not necessarily mean market is not efficient. Okay, so let's suppose if a stock have a permanent component and that's sort of random walk, and the temporary component that's mean reversing, right? Then if you regress the long run returns on the long run return lag, then you have a negative efficient. And that's sort of due to a paper in Pharma French in 1988. So what they do is to regress R from T to T plus bigger T on this R from T minus bigger T to T. So this bigger T can be 2 years, 3 years, 4 years, 5 years, right? So this is a regression of the long horizons. So what you can see that average beta is about negative 0.3. Right, so these are sort of all the different industry portfolios. If you look at the average, that's about negative 0.3. That's 3-year horizon, right? Because this is 1 year, 2 years, 3 year, 4 year, 5 year, 6 year, etc. as we can see, as we saw before, in the sort of 1 year horizon, this number is really, really small, right? Negative 0.03. And that's not significant, as we just saw before. Now, up to the 3 year horizon, this increases to negative 0.3. And what's the t statistic? The average standard deviation is 0.15. So the average t is about -2. Right? 0.3 divided by 0.15. So that's just -2, and that's significant. So what we see here is that the 1 year annual return predictability is not there, but as you actually increase the horizon, this predictability is there in the long run. You know, if you look at sort of 3 year, 4 year, 5 year, that all looks like predictable. But if you go into longer horizons like 6 year, 8 year, 10 year, again, it becomes insignificant. All right, so what you see here is that around the 3 to 5 years horizon, you can see some predictability in the long run returns. Right, so there's two possibilities. One possibility is in the long run, you have mean reversions. That's sort of temporary, right? Second possibility is something in the rational explanation in sort of the people's investment behavior induce this long-run predictions. Right? So what is this 3 to 5 years? Well, 3 to 5 years sort of coincide with what people have in mind of a typical business cycle. Right? So there's also a possibility of this predictability is actually sort of coincide with the business cycle. Okay. So two things we learn from this. The long run, 3 to 5 years, return are negatively correlated, and the prediction coefficient is actually quite big, about 30%. So let's see it with our own data. What I get is a 12 industry portfolio from the PharmaFrench website. Right? And I calculate the 3 years, 3 annual returns with this cumulative product for the duration from 1930 to 2014. And then I just calculate the lag. Right, so I'll just take one example, manufacturing. So return of manufacturing on the lag of the manufacturing return in the 3 year horizon. What we have here, coefficient is about negative 0.33, or actually 34. The t statistics is right around 2. All right, so this is a negatively significant coefficient. And this is actually consistent with what PharmaFrench found in their 1988 paper. So you can see, what I use, the data I use is actually from 1927 to 2015. So the data actually extended from this 88 paper, and this is still also true. Right, so this long-run predictability has not been going away. So the question here is that, how do we actually explain this predictability? So explain the predictability, I want to introduce a concept that's called the dividend ratio. Dividend ratio is basically your D over P. Right, so where's the price that you pay for the stock, how much dividend you can get from that stock. So sometimes if this P is T minus 1, you also call this dividend yield, right? Because that's the yield that you can get from the dividend by buying the stock. All right. So the value-weighted index, or the value-weighted return, is basically your price plus the dividend divided by the last period price minus 1. Right, so this is the value weighted with the dividend. Your value weighted without the dividend is just PT over PT minus 1 minus 1. Right? So from this value weighted with the dividend and the value weighted without the dividend, we can actually calculate the DP ratio, or called the dividend ratio, and the dividend growth rate. Why is that? Because if we take the value weighted with the dividend plus 1 divided by the value weighted without dividend plus 1, that's the ratio, and the minus 1, and we sort of just plug in the definition we find above here. You plug this in, cancel the PT minus 1 out. What you get is just DT over PT. Right? So if you have a portfolio of stocks, it's quite hard to actually calculate what is your portfolio's dividend, what is your portfolio's price. Right? But if you know the portfolio's value-weighted return with the dividend and the value-weighted return without dividend, then you can calculate your portfolio DP ratio, or the portfolio dividend ratio, by using this formula. Okay? Now, alternatively, we can also calculate the dividend growth rate, which is DT over DT minus 1. And again, we plug in the definition. We find out this is just the DP ratio at time t over DP ratio at the time t minus 1 times the growth rate of return without the dividend. So we can actually calculate the DP ratio and the DD ratio based on the value-weighted returns with or without the dividend. Right, so for example, I have this MSI annual return, and I can calculate my DP ratio just by plugging into this formula. This is value-weighted with the dividend minus this value-weighted without dividend minus 1. I can also calculate my DD ratio. Right, so although we have the value-weighted returns, we can actually recover the dividend ratio and the dividend growth from this. If I plot what my DP ratio looks like, so this is from 1920 something, right? And this is going up, then down, going up, then down, going up, then down. Although it looks like there's some trend of going downward, that's because firms are actually paying less dividend nowadays than before. Nowadays, they do a lot of repurchase, right? But nevertheless, we see in the long run, this looks like stationary. But if you look at the price itself, that's not stationary, right? But the DP ratio is actually stationary. And DP ratio is persistent because any sort of small change in DP will actually have big effect later on. So what I want to do first is to regress the DP ratio on the lag of DP ratio. Right. So DP ratio is persistent, meaning this coefficient is actually quite large. It's about 0.9. All right, so lag of DP ratio can actually predict the current DP ratio, and this coefficient is quite close to 1. When it is equal to 1, then it's random walk. Right? So this just shows you the persistence. If I regress DD ratio, which means the dividend growth on the lag DP, then this coefficient is small, negatively small, and not significant. So what does that say about the dividend price process? The dividend price ratio can predict the future dividend price ratio, but cannot predict the future growth rate of the dividend. Okay? So if you think about what DP is dividend divided by price. Right? So it's either predicting the change in future dividend, that's in the numerator, right? Or predicting the future change in price, which is the return. Okay, so this gives us hope that the DP ratio actually is predicting the future return instead of future dividend. Okay. Now if I run the regression of future return on the lag DP, what I see here is coefficient is really big, and that's highly persistent. So indeed, the DP ratio predicts the future price movement, which is the return, but not the future dividend movement. Right, so the lag DP predicts the future DP, not the dividend growth, and the lag DP predicts the future returns in the long run. Let's take a break, and we'll explain why this is actually relevant. Should we start? Okay, so let's start. So what we've seen before the break is to sort of calculate the DP ratio and the DP ratio prediction from this decomposition of value-weighted return with or without dividend. Alternatively, I can use Robert Shiller's data. Robert Shiller is the same Robert Shiller at Yale who got the Nobel Prize, I think a couple of years ago, 2014 or something. He has this data that's calculated from, I think, S&P 500, the average price, the average dividend, the earnings, and the return percentage, like that, right? So if we calculate from his data, we can again plot the DP ratio, as we've seen before, and you can find that this is really, really similar from the graph we have before, this one. All right, so this is from the decomposition of the value-weighted returns, and that's coming from directly of the price and dividend calculations. All right? So we can also calculate the regression of log DP ratio on the lag of this log DP ratio. Again, this coefficient is really, really persistent, more than 90%, and that's highly significant. We can actually alternatively, instead of calculating the DP ratio, we can alternatively calculating the EP ratio, the earning price ratio. And the earning price ratio, it's a little bit from DP ratio, but you still see this persistent and sort of the stationary series, right? And it's sort of going down a little bit, but more, nevertheless, it's sort of going up and down, up and down. It's stationary, which means what goes up must goes down. By the way, can anyone guess where we are of this DP ratio right now? Really high? Should be really low, right? Because we have, if you watch the news, in the US, they have the longest bull market right now. So the price of the stocks are really high. The earnings cannot catch up with the price. So, you know, this is one of the things people talk about when they say the market right now is really risky. Because if you really think the EP ratio is stationary, that means what's going down has to go up. Of course, the question is, you know, would this going down in the long-term trend of going down, or is that the stationary part that's have to go up? Right? But why EP ratio actually reflects the similar pattern of the DP ratio? All the dividends should be coming from the earnings, right? So earning, you can either pay it out as dividend, or you can retain the earnings, which you use for investment, okay? So all the series I talk about today, although I use the DP ratio, but it should go through also with the EP ratio as well. Okay, so let's look at some serious regression of the long run with horizon year 1, 2, 3, and 5. Regression of the returns on the DP ratio and the dividend growth on the DP ratio as well. The regression I did before is just 1 year, right? Now you have multiple years. This is from I think, Cochrane's paper in 2008. Right? What you see here is B here is O significant. Right, so 5 divided by 2, that's more than 2. 10 divided by 3. 11 divided by 4. 33 divided by 6. They are all significant in terms of T ratios, T values. Right? And R squared here is quite big. So that means the high DP ratio will lead to high returns. But why DP ratio is high? Is dividend very volatile? No, the dividend is very smooth, right? So what's leading to the change in DP ratio is mainly the price. So high DP ratio, in other words, that's the low price, leads to future high returns, right? And R squared is high and increases when you increase the horizon from year 1 to year 5. If you look at the right panel at right, you see that these R squares are small, right? And a lot of those are not significant. 2.5 divided by 2.1, that's not significant. 2.4 divided by 2.1, 4.7 divided by 2.4. These are not significant. So the DP ratio cannot predict the future dividend. In other words, the changes in price currently is a prediction of future change in price, not a prediction of future change in dividend. So how can we actually understand this? Let's actually look at how the DP ratio and the returns are defined. Right? The gross return, as we've seen before, is just price plus dividend divided by the lag price. Right? If the returns are all constant, the expected return are all constant, then we can solve for the current price, right? Which is expected of the future dividend divided by 1 plus the constant R, right? And then you can iterate this forward to get the future price equal to sum of all the discounted dividends. Iterate this forward, meaning you plug in this definition for PT plus 1 again in here. So PT plus 1 equal to expected PT plus 2 plus D of T plus 2 divided by 1 over R. Then PT plus 2, you need to use this formula again, right? So you use this formula again and again. You have two components. One component is just the discounted dividend. The other component is the price that's discounted, the end price discounted from really, really distant future. I think that's the same as your Finance 101, sorry, that's not called Finance 1, called Foundation Finance class, right? Or any of the sort of fundamental investment class. The price you can compose into two components. One is the future dividend or future cash flow. The other part is the end value, future end value, right? If this K goes to infinity, which means in the really, really distant future, the second part goes to 0 because the discount times to the power of K is almost 0, right? So the future value doesn't really matter if it's really, really distant future. So what you end up with is this dividend discount model, which says the price equal to the sum of all the expected future dividend discounted. That's basically what you have seen before. Right? Now, the only thing that's different in this class is that the discount rate or the return is no longer constant. Okay? So now let's start by taking log of this returns. The log of return, 1 plus r, on the left-hand side, they give you this little rt plus 1, the log of return. On the right-hand side, you have log of pt plus 1 plus dt plus 1. So this is the top part, minus the log of pt. Right? And I can write this log of pt plus 1 plus dt plus 1 as log of pt plus 1 times 1 plus dt plus 1 over pt plus 1. And this is log of pt plus 1, so this is the little pt plus 1, and this is the log pt, that's the little pt plus 1. And what's inside here, log of 1 plus dt plus 1 over pt plus 1 is just this part. The log of 1 plus this ratio is just e to the power of little d minus little p. I'm just doing the log transformation. Right? Now what we can do is to take the log linear approximation that you can find at the end of this lecture in the appendix. Basically, we just use the Taylor series expansions with some log transformation. Right? So what you can, I'm not going to get into the details because for one, I don't really require you to be able to do it. For two, it's something we already talked about. It's just Taylor series expansions, right? But what you can get is this equation, or if we go back, this equation, which is the RT plus 1 is approximately this kappa, which is a constant, plus rho times the pt plus 1, plus 1 minus rho times dt plus 1 minus pt. And this rho is just 1 over 1 plus dp, which is approximately 0.96, because the average dividend ratio is about 4%. Right, so now we have a linear expression for log of the returns and the log of the price. So everything is linear again. We can use iteration again. If we ignore this term, kappa, that's the constant term, that wouldn't affect any of our iterations. And we just take this iteration part, right, and iterate forward. What we can solve for PT is just PT equal to expected sum of discounted future dividend minus the return or the discount rate. Right, so from this expression, you can solve for PT. PT equals to rho pt plus 1 minus rho dt plus 1 minus RT plus 1, right? Then PT plus 1, you can then again plug into this equation. PT plus 1 equals to rho PT plus 2 plus 1 minus rho DT plus 2 minus RT plus 2. And you iterate this forward just as you do before, you will get this. You get this equation. Right? So if you look at this equation actually have two parts. One part is rho to the power of j times 1 minus rho dt plus 1 plus j, this first part. That's just the present value of your future dividend. Right? And the second part is rho to the power of j times the RT plus 1 plus j. That's the present value of your future discount rate. Right? So the current price can be written as two parts. One part is present value of the cash flow, because it's related to the dividend. The other part is the present value of your future discount rate, or the returns. Right? And you notice we didn't actually do anything fancy. This is all coming from the accounting identity. Okay? The accounting identity says if we accept that the price should reflect all the future dividend, then we can write the log price as these two components. Right? So everything is just accounting identity. So we see here that the price is driven by two expectations. One expectation is the cash flow or dividend expectations. The other part is the discount rate or the return expectations. Now, with this price expression, we can calculate the log DP ratio. Log DP ratio is just DT minus PT. That's expected future discounted change in dividend and the future return. All right, so if you have dt minus this expression, you'll get this. So what does this equation tells us? This equation tells us the log dividend ratio can change if either of these two things changes. Your future expected dividend changes, or your future discount rate changes. Right? DP can move if and only if there is news about either the future dividend growth or the future return changes. So delta of T plus J, that will be the future return growth changes. RT plus J will be your future return changes. All right, so this graph we see the DP ratio goes up, then down, goes up, down. This reflects either the dividend change or the return changes. But we already see some regressions, right? Does the DP ratio predict the future dividend growth change? Not really, right? So most of the DP ratio actually predict the future return change or the discount rate change. All right, so if we run the regression of log DP on this change of the dividend and the discount rate of the long run, the coefficient should sum up to 1, because if you take the variance on this side and the variance on that side, should be equal to 1. All right? So the coefficient should be 1, and the relative magnitude of coefficient should give us indication of this importance of the discount rate versus the dividends. So here's the regression coefficient of this long-run regression, coefficient on return, and the coefficient on change in dividend. So you notice this is 1.09. This delta D is 0.09. But remember, there's a negative sign. There's a negative sign in front of this delta D, right? So this should be negative 0.09. So this sum up should be equal to 1. Right, but relatively, between this return and the dividend change, what's really driving the DP ratio is the return, because that has a much bigger coefficient than the coefficient 0.09. So this gives us what's called, so there was a new thinking in finance, or new fact in finance. So if you look at this graph, this blue line is a price series, and the red line is the dividend. As we said, the dividend is really smooth, right? So most of the DP ratio change is driven by this blue line, the price changes. Now, if you, at this time period now, you look at the DP ratio, you'll say your DP ratio is really low because, sorry, your DP ratio is high, actually price is low, right? So what do you predict about the future? The classical view is that if your DP ratio is low, that means your future dividend will be going down. So this red line should go down. And the future price will remain the same. Right? So the classical view is, if I see a high DP ratio, which means the current price is high, the current price is low, that means if my current price is low, the return has been negative, that must mean the future dividend will be going down, or the future cash flow will be going down. That's the classical view. The new fact view, which we actually see again and again in this lecture, when we see this DP ratio going up or price goes down, the new fact says this price actually must go up in the future, which means it predicts the future returns will be higher, or the future discount rate will be higher. But the future dividend will stay the same. So the DP ratio do not predict the future dividend, but it predicts the future DP or future return. And that's actually really significant, right? That means if we take sort of the long view of 1 year or 3 year or 5 years, what we're seeing of the aggregate price movement, like S&P 500, this actually predicts the future expected returns, not predicting the future dividend changes, right? So when you see a price goes down, you will say, what does the price goes down mean? Price goes down means the required rate of return or future discount rate will be higher. Right? Why the price goes up? The price goes up because people expect in the future, people requires lower required rate of return. Or people's discount rate becomes lower. So anything about the price is an indication of the future price or future returns. Price is not representing the price now. Everything is forward-looking. Okay? So this actually has significance about, things like if you have long horizon in your investment horizons, how would that actually change in terms of investment? Right, so if you are someone who sort of are investing for your first house, for example, which is probably 5 years away, so your investment horizon is 5 years, versus if you are someone who is investing for your retirement, which is probably 30 or 40 years away for you guys, right? So this investment horizon will be relevant in your investment decision. Because if you have really long horizons, what's going down now is just reflecting the higher future expected returns. So I have some summarization on this practicality and implications. Right? So the return news, or the discounted news, or the risk premium news, they are just the same things, right? They are reflected in the stock price, not the cash flow news. And as I said, although we are looking at DP ratios, but you can look at many more variables, such as EP ratios or BM ratios. Essentially, they are all reflecting the same thing. Okay, they are all reflecting the future expected change in the discount rate. So the market volatility is mostly driven by the expectation changes in returns, not by the cash flow news. So in that sense, you can say the market volatility is actually excessive. Market volatility is not really reflecting what's called fundamental, which is the cash flow news. Right? It's reflecting the future expected return changes. So Robert Shiller has this book, I think it's called Irrational Exuberance, right? So if you read that book, all he talked about is, the market volatility is very excessive, sometimes is actually border on the irrational. So you shouldn't really pay too much attention to the sort of short-run volatilities. The question is, why wouldn't people actually trade on this predictability, right? And what's the equilibrium implication of that? So what I should emphasize is that although we called it predictability, but we don't really know the causality of it. What do I mean is, we don't really know is that the price decrease today that's causing the future price return increase. Or the price decrease today is actually just a reflection of future expected return increase. We don't know which one causes which. Although we're sort of running, future returns on the lag price or lag DP ratio. But I can also run the lag DP ratio on the future returns. Because we are running the future return on the lag DP ratio, so that looks like it's prediction. Okay, because it's lag explain the future. But if I just switch the dependent variable and the independent variable, I can still get the significance, right? So there's nothing that says this prediction is actually prediction in the causality sense. So everything should be actually in equilibrium, right? The expected return is high because it requires to be high. For example, in a depression, right, people require a very high return to compensate for their risk. Right, so this fundamental pricing theory, 1 equal to expected MR, will still hold in our predictabilities. Or in other words, the long-run predictability can be perfectly rational. Right, so the predictability just says the coefficient of the M and R is important. Predictability doesn't necessarily mean the market is inefficient. It just means that the risk premium is recession-related and slowly time-varying. But if we sort of have this unconditional view of the CAPM with constant lambda, that doesn't hold. All right, what we really need in this kind of implication is that we need some model that's conditional, and we need the risk premium lambda to be time varying, not constant across the time. Okay? So that's sort of the rational explanation, right? Alternatively, I can write them down a model that says the price equal to the fundamental price, which is P star, plus some sentiment ST. So this is sort of fundamentally that's rational, right? But sentiment act as sort of the error term. But how my sentiment will actually change? My sentiment is mean reversing or has coefficient in the lag sentiment. So ST will equal to some rho times ST minus 1 plus some error term. So this ST, what we call the sentiment, it has a very small mean reverting component, which means this rho is less than 1, but sort of not very far from 1. It's very persistent, slowly changing sentiment, right? So when people have high sentiment, the stock price tends to be high because people are willing to buy more stock. People have low sentiment, the stock price tends to be low, right? So if you have short horizon, the returns, which is PT minus PT minus 1, that's equal to the P star will cancel it out. So that will equal to ST minus 1. That's equal to rho minus 1, ST minus 1 plus this mu T. And because we said that this rho is very close to 1, this first component is almost 0. So in the short run, the log price change or the return will be almost just the random walk, just the UT itself. But on the long horizon, if I take the expected PT plus K, that will equal to the P star plus rho to the power of K times ST. And we know the rho to the power of K will go to 0 when K becomes large. So in the long run, this expected PT plus K will approximately equal to just P star, the fundamental price. So you have this mean reversion in the long run, which means the expected long run price should be equal to fundamental. Anything that sort of goes up will actually goes down to the fundamental. Or anything goes down will goes up to the fundamental. Now you also have this case of in the long run, you have mean reversion. In the short run, you have random walk. So observationally, this is the same as what we see in our data also. Right? So this is an alternative explanation of the sentiment of this why you have long-run predictability. This explanation says people are subject to behavior bias, right? And this behavior bias is correlated and very persistent, which means the behavior bias have this role that's very close to 1. Right, so although we mainly talked about these rational explanations from DP composition, or we call it the Campbell-Schiller decomposition, but you have alternative explanation that's coming from the behavior series. So why we have, 2 explanations, one rational, one not rational, can both explain our data? That's because at the beginning we already said the market efficiency is really a giant hypothesis. Just by looking at the data evidence is not enough to actually tell us market is efficient or not efficient. It can be perfectly related to the rational exploitation. You have predictability, but you don't have inefficiency. Or it can be based on the behavior model. It can be predictable and inefficient, right? So because of this giant hypothesis problems, we don't really have a way to differentiate, which explanation is really correct. That's part of the reason in sort of new strand of finance, we tend not to spend a tons of time to really debate market is efficient or not efficient. Instead, we use sort of statistical approach, multi-factor approach to see, whether you can take advantage of so-called inefficiency or take advantage of so-called factors in the rational explanations. All right, so for example, you've seen, people talk about smart beta. Smart beta is just a tilting towards the factors. You're already seeing the factor regressions. You're already seeing how to actually replicate the factors using a portfolio of stocks, right? So for example, if you want to tilt your portfolio towards the value factor, you have those beta of the stocks that's formed by replicating the value factor. So this is sort of one of the approach people has been using quite often recently. That's it. And if you're interested in the derivation, I'll actually encourage you to. You can go through this appendix to see how the things actually derived in terms of linear approximations. All right, I'll see you on Thursday. This 这个东西就是这个 mu 就是 expectation 啊。对啊，这个就是 expectation divided by standard deviation， 所有的都是，如果你把开一个根号的话，这个只是所有的东西都是就是 mu over sigma square。对啊，这个 mu over sigma 就是这个东西。
其实就是说这个东西跟就是开个根号，其实就是这个 term，这个 term 只是减多了一个 risk free。OK， 还有它这里，你刚刚不是说它 significant， 它是它0.057，它不是应该我要不能 reject， 就是它是等于0。
这个是 probability， 对啊。
对，那你刚刚又说它是 significant。
是 significant 啊，因为它这个 p value 是只有大概5% 到6%。
但是不是一般都是那个 criteria 是0.05？
那你一定要0.5，没有这个，对啊 ，statistically 这个没有这么回事，这个是你们的误解。
哦，这样的吗？哦，好吧。就是那个 Schiller， 它就是你最后讲的那个东西，就是它是从 behavior 那个角度来解释那个东西是可以 predict 的。 是吗？
对啊，
哦，前面就是用了一个 rational，就是 factor model， 一般都是一个比较 rational 的一个东西。
对啊，rational 的 explanation。rational 就是完全是从那个 accounting identity 就直接可以 derive 出来的。
那 behavior 呢？就
behavior 就是那个就是我跟你讲的那个，
就是那个 appendix 吗？
没有啊 ，behavior 是那个 sentiment model 啊。
哦 sentiment。
所谓的 sentiment 就是 behavior 的。
哦，就是这个 S 是代表那些消费者的，不是那些 investor 的一种行为。
对啊 ，investor 的感觉。
感觉，就是那个 sentiment 那就很虚，那我怎么知道那个 sentiment 应该用哪些东西呢？
这个你要读个 PhD 吧，才能知道啊。
哦，这样的。
啊。
那一般就是 behavior 的时候都是用这个 sentiment 这个 model 吗？就是这个它的一个比较 general form 是哪个 form？
你说 sentiment 的 model 啊？
对对对，
不就在这吗？就这个吗？
哦，就一般来说，就是如果我要用 behavior 会用 sentiment，就是建立一个这样的一个 model。
对啊，就是这个 model 是建立在 sentiment 的基础上的。那这个 model 的这个 prediction in the long run and in the short run 都是跟你的 data 是符合的。
哦 ，OK。然后这个 sentiment 就等于我一个这个 rho 又是什么来？这个一个就是一个
rho 就是 correlation coefficient 啊。
什么的 correlation？
就是你的 sentiment 是 correlated 的，你下个月的 sentiment 是 based on 今天的 sentiment，你不是一个喜怒无常的人。OK， 你如果高兴了，你下个月也 more likely to be happy。但是这个可能会 slowly change。
哦，OK，懂了，谢谢。